And at the Farm Progress Show, had a chance to sit down and visit with the CEO, that's Chief Executive Officer of Farm Credit Services of Illinois, of course one of our sponsors of the Farm Progress Show coverage and our Farm News Daily on WLDS. And Dave, good to sit and talk with you, and thank you for supporting Farm Radio.
I was just sitting here thinking, how do you get the hottest tent on the whole grounds here?
We're full of hot air.
I wouldn't say that.
Well, it's certainly an interesting time in U.S. agriculture.
Oh, yes, it is. Agriculture across the country is pretty diverse, you know, and we're sitting here in the middle of the country. Heavy grain operations here doing extremely well. But farming across the country has got a little bit different picture. The Northeast has a lot of nursery operations, and they're tied to the local and national economy more than we would be here in the Midwest. They've had some stress and some problems there. The southeast part of the country and down into Florida, just the absolute decline in real estate values overall has made its way into agricultural land as well there. So they've had some issues to deal with. The Northwest, timber. I mean, these are things we don't talk about much here in the Midwest, but you can imagine the timber industry is devastated. So we're very fortunate to be here with grain operations and the livestock operations that we have.
And likewise, of course, the drought in Texas and Oklahoma, the farmers there, you know, it's got to have a tremendous impact.
Texas is a state that has to have wells for water. There's no aquifer there. If you were to buy a piece of real estate in Texas, the first thing is to check out all the wells on those properties. The plats come there with a mark for each well. Each well has 10, 15 years of history in terms of its water table, and so yeah, it's not good there right now, and everybody wonders where's the water going to come from for them.
So let's go kind of condense it down to the Midwest, to the corn, soybean country. Farm economy probably pretty strong.
What's I didn't check the markets today. The December corn today, is it 760 or is that down?
Down just a couple of cents.
Okay, and beans probably 14.50. Input costs, of course, always are an issue. Although input costs are down from maybe 2 years ago because of fertilizer prices. But right now, farm earnings are just really good right here, and the quality of the balance sheets that we see coming through are exceptionally good. Strong equity positions in the operations, they're not very leveraged. Strong working capital positions, and of course that's all good for us.
But would you envision that potentially changing quickly if we were to see a rapid decline, which no one is predicting necessarily, but we know what happened in the 80s into land values?
Well, land values, of course, are a function of, you can look at it several ways. One that we look at is the farm income produced from that acre of land over a period of time, discounted for a particular interest rate. I mean, that's a typical way to look at it. Right now, the land values are high, no doubt, but they're justified based on those factors. As a lender that takes that property as collateral for 15, 20 years, or whatever the case may be, the one thing we get concerned about is sustainability. How long will those commodity prices stay at this level? Will they go up? Some would argue that, yeah, they're going to be at this level for a long time and may in fact go up. Some have said that the United States may become the Saudi Arabia food for the world. We can't predict those things. One thing, though, that we're pretty certain about is the interest rate environment. It's low right now, expect to be low for some time, but over the next 15 or 20 years, it's likely to go up. And interest rates do have an impact on the value of the farmer. Just a 1% change in interest rates makes a pretty significant change in the value of that farmer.
It does indeed, and that's interesting because, as we know, the Federal Reserve, after their last open market meeting, came out and said, you know, they were going to leave interest rates low for 2 years.
Yes.
And yet some of the farm economists are suggesting that farmers should take this opportunity to take some of these profits, that if you have good crops this year, and pay down debt. Would that be the thing, or would it be better to save some of that money for a later date and maybe take advantage of locking in rates now, maybe borrowing more than what you might either need or justifiably would have?
Well, a couple of issues there. First of all, we like to have operations have a pretty good source of working capital. And to many operators, they look at that as idle funds. It's liquid. The return on that is next to nothing, that sort of thing. But you've got to have a buffer there to be able to pay the bills when they come in. The other parts of that, what will happen to the world demand for grains? We don't know that, but margins are very important on the farm. And what happens when the real estate values are strong, the income is strong? Over time, the margin starts getting a little tighter because inputs start going up as well. And one big input for a lot of operations is cash rent. The cash rents right now are lagging behind the increase in the real estate values. Type A farms have gone from about 6,000 2 years ago to 8,000 last year, now about 10. Cash rents are up some, but not that dramatically.
So I guess the bottom line is, of course, the other thing is we get through harvest, farmers will start looking at their books, and very prudent to do so, and see on the tax scenario and all. But again, if you're going to lock in rates, do you do it now or do you wait?
Well, rates right now, short-term rates, most of our portfolio is migrated to the low end of the curve, short end of the curve. Short-term real estate interest rates now in the 3% range. I mean, that's almost nothing, but it's something if you borrow a lot of money. If you go to 20 or 30 years out on the yield curve, those get up to be 5 or 6%. And so that's a pretty steep curve, 3%. And so it's a barrier for somebody today thinking about wanting to jump out on the yield curve and lock in that rate for the next 15 or 20 years. One of the things we like to do with customers is invite them into, we call it segmenting their debt. We can take the loan and break it up into 1, 2, or 3 parts, whatever they like. They can keep some short term. They can go out and extend out to the 15-year mark of the curve, something like that. And in the process, they've hedged a little bit against the rates going up, but still enjoying some of the lower rates that exist right now.
And of course, you offer a wide array of products to suit each individual farmer's needs.
We've been very fortunate there. Farm credit is funded through the sale of bonds. We don't have deposits. And so investors are willing to purchase bonds for longer periods of time. In 2008, everything went very short term. There was no long-term bonds being issued, but today we're issuing those. We're able to offer those long-term products, and we match fund them, so we're not taking interest rate risk with them. And Farm Credit's got quite an array of products. Our funds failed program is extremely interesting for a lot of people. Long-term rates, and we now sell crop insurance, and of course that's a big risk mitigator for most operators.
Is there a lot of equipment leasing still going on?
Equipment leasing was really big back when the investment tax credits and accelerated depreciation issues were a little different. It's still an alternative today. I don't know what percentage of our equipment sales go into leases, but it's still a pretty dominant product.
How competitive is it in that machinery arena when we've got this low interest rate environment? Is the machinery companies and their financing arms the biggest competition?
They can be tough competitors. Back in 2008, when the financial crisis hit, those captive finance companies, we call them, they have to raise money as well. John Deere fared pretty well during those times. Some of the other ones did not fare as well. They can come along, and because they're doing two things, they're trying to sell the equipment and they're trying to finance as well, they can offer rates that we can't compete with at times when they're trying to push a particular line of equipment.
So again, what people need to do, it's a great environment now. They need to come in, check in their local branch, and see what they can do for them.
We have a full range of products to choose from if they'd wish to jump out on the yield curve a little bit more. And as I said, if they want to hedge a little bit, they can segment the loan with us and have some short term and some longer term.
And finally, any problem? For many, many years, the farm credit bonds have been very sought after by the investment community, from what I've understood. Seeing any weakening of that demand?
I will tell you that back in 2008, at that time, about 40% of the farm credit bonds were being purchased by Asian countries, central banks, China, Japan, Korea. When the financial crisis hit, they discontinued purchasing them. And so we had to go to the domestic market to sell them. A lot of it went to very short term, not very long term. But today, those markets have all been redeveloped. The farm markets are coming back pretty strong, and we're in pretty good shape.
Well, again, thank you for supporting farm radio and the farming community, and I know people appreciate it.
Thank you very much for having me.
And that's Dave.